How's it going, friends and family? Today we're going to be talking about silicone motion technology, ticker symbol SIMO, and it's a stock analysis that was requested by a viewer like you. Now, as you take a look at your screen right now, in the past trading day, February the 8th, they're up 7.4%. And if you just do, year to date, 48% into the green. We zoom out, let's say 5 years, 144%. But if you look between the lines, seems like for the majority of 4.5 years, they pretty much flat, right? At about $60 or so dollars. But leading into, I would say the second half of 2025, they were still around that $60-ish mark. But in the past 7 months, they've been ripping. So in this video, we are going to be analyzing what the heck is going on. And through that process, we're going to be calculating a fair value for their stock price. And before we go anywhere else, I have to say, their ticker symbol, SIMO, I really like it. I really like it. And just for fun, let's take a look at 10 years, 470% into the green, but for a majority of those 10 years, relatively flat in terms of their share price appreciation. I mean, that's not true. They went from about $43 to $53-ish in 9 years, but then in the last 7 months, they're exploding. Past 20 years, 1,100%. All right, so by definition, I guess they are a compounder, but there's a lot of highs and lows. Keep that in mind. Highs and lows. I'm going to circle back to that later. And by the way, SIMO, they're in the business of making NAND flash controllers, which is a very key ingredient for SSD storage. And on that note, we should talk about what exactly they do and how they make revenue. So SIMO is a B2B operation that supports the AI data center infrastructure because, if you think about it, without SSDs, data centers would be forced to rely on mechanical drives, also known as hard disk drives, that consume 10 times the power and floor space. It's a lot more bulkier, heavier, and it's mechanical, right? When you think about it, as it stands right now, the data centers, they're super energy hungry and there's so much power demands. And so if you go in the route of hard disk drives, it would make the entire operation physically, but also financially unsustainable because it would take up a lot of real estate in the warehouse itself. Now, with that said, it's important to keep in mind that silicone motion technology, they don't physically make the NAND flash controller. Instead, they make the designs and then send that design to a manufacturer such as TSM to make it for them. And on that note, when you think about SSDs, they make any system operate faster. So what I'm trying to say is if you're still rocking a very old laptop from 2015, 2014 or whatever, that has a hard disk drive, I'm telling you right now, just swap it out with an SSD. I promise you, it'll be a brand new experience and that bad boy will boot up in 10 seconds. Because I personally used to have HDDs for all of my computers, laptops, and everything up until 2014. It's a game-changing experience because with a hard disk drive, when you boot it up, it takes a minute or two. And if it's a very old device, sometimes 3 to 4 minutes. With an SSD, dude, everything just goes faster, quicker, and it's a lot more efficient. And so who are the customers that silicone motion technology are selling their NAND flash controllers to? It includes the SSD stocks that are crushing right now. Micron and Sandisk formerly was a part of Western Digital. And moving right along, let's talk about the recent developments that's surrounding SIMO. They just posted their earnings on February the 4th. It was a mixed bag, but the guidance and the forecast going forward, I think, makes up for it. What I mean by that is their top line, their revenue was up by 46% year over year. And on the other side of the spectrum, their bottom line expectations, they missed. However, it doesn't really matter because the market's forward-looking, and what they said about the future, it made every nipple on Wall Street very sweaty, lactating because they're excited about what's going to happen to silicone motion. So the AI data center gold rush, it's helping them to forecast a record-breaking year for fiscal year 2026. And the reason being is that SIMO's controllers are being used in the Nvidia AI server systems. So they're partnering up with the biggest dog in the AI data center fight. Because of that, it's helping to propel their gross sales. So in the context of an AI data center, you can think of the Nvidia GPU chips as the brains. And it helps the LLMs to operate. Whereas on the other hand, SIMO's SSD controllers are the high-speed nervous system that helps the brain to make sure that it's never stalling or going slow or stagnant, and that the brain can be super optimized. Just like taking fish oil every single day, dude, that's what I've been doing for the past 2-3 years. Game changer. I think it's funny how, as amateur investors, how do we not see this on the wall that SIMO was going to thrive eventually? Like in 2023, 2024, and for the most part of 2025, dude, they were just dead in the water. They weren't moving. It was pretty much trading flat month to month, year over year. How did we not anticipate that SSD were going to be the next big dogs in the AI data center race? I mean, if you look at Micron, Sandisk, Seagate, dude, they're all exploding in valuation. I'm embarrassed. I don't know how I didn't predict that as well. So all that to say, as long as the data centers are still booming and it's a gold rush, I think SIMO is going to ride the wave. And I think it makes sense, at least for the next 365 days, because based on the earnings that have just happened in the past 2 weeks, we know that Amazon is going to be spending $200 billion in capital expenditures, which, in other words, capex, in building out more physical infrastructure, data centers, $200 billion. Now, obviously, not all $200 billion is going to be allocated towards AWS. I think it's like $180 billion. The other $20 billion is allocated towards Project Leo and the other endeavors that Amazon's doing, but I would argue a majority, 90% of that money is going towards data centers. And then we also know that Microsoft's going to spend about $150 billion in capex for their Azure cloud network. We know that Google's spending about $185 billion in capex, and Meta is spending $135 billion in capex. So the Mag 7 alone, they're about to spend just shy of $1 trillion in capex for data centers, which means SIMO is going to get a piece of that pumpkin pie. I would argue that's the best pie flavor out there. I don't like when people, they try to be a smart ass and they say, no, man, the Chicago pizza, that's the best pie. And I'm like, I get that's a pie, but in the context of what we were thinking for Thanksgiving, it's like apple pie, cherry pie, pecan pie. Pecan pie is the worst out there. If you've never been to the US and someone puts you on about pecan pie, just pass up on the offer. Do not try it. It tastes like booty hole. Pumpkin pie, though, on the other hand, delicious. Green apple pie, dude, out of this world. Cherry pie, also very good. So if we take a step back and think about all the other physical infrastructure that's supporting the AI data center race, or I guess the gold rush, I think everybody is going to be benefiting from the Mag 7 spending so much, why am I so far away from the mic? Spending so much money on capex. So when I think about HVAC, when I think about the utilities, and then of course the actual data center real estate, so data center REITs like Equinix and Digital Realty, but I would argue also the ones that are making the server racks where all of the stuff goes into, such as Dell, HP, SMCI. So I think in the context of the data center expansion race, there's a lot of different ways to make money. You don't have to exactly just invest into Nvidia or TSM or just into a power utility that's located in Nova, which, by the way, based on my research, there's a crap ton of data centers sprouting up in Loudoun County and Prince William County. I'm actually from Nova, right outside of Washington, D.C., and to see that my hometown is becoming a hub of data centers, it's kind of weird. Now, if you're curious, the energy utility for that region is Dominion. It's neither here or there, but I just sold out of them after holding on since 2019. And I made the executive decision to sell out of them because after 7 years of holding on to Dominion, the ROI, it wasn't the greatest, and I needed to use that capital in order to invest into some of the software stocks that are being sold off right now. So I could absolutely be wrong, but I think the ROI of pivoting that capital from Dominion Energy into Microsoft would probably yield a better CAGR. As a guy that's 35, I feel like that makes more sense to me. I don't know. And I apologize up front, but I have ADHD. So just to take a quick glimpse at the landscape of the utility sector, I want to see if there's anybody that's kind of near their 1 year low, like that opportunity to buy into them before their inevitable rebound. I think Constellation Energy is the first one that pops up on my radar. If we take a look at what's happening in the past like 3 to 4 months, they were roughly $412 a share, and I think that was the case back in October and I guess at the end of October, but they've been selling off. I think about a month ago, I read an article from the Wall Street Journal that said the current party in power, they're going to be capping how much Constellation Energy is going to be able to charge for their services to power up the data centers that are located in New Jersey. So I think that made the markets kind of spooked out, but it's not set in stone yet. It's just one of those threats, like verbal threats. We're going to do it, but it's not actually in paper. And I think that's one of the drawbacks of the utility sector as a whole, is that most of them, they operate as a regulated monopoly or a duopoly. So like when you move into a specific neighborhood, you usually don't have a diverse array of options for who's going to provide power to your home. You usually get one option. You either go with them or you're going to have to buy a crap ton of solar panels from Seagate to power up your house. I think most of us were just going to bite the bullet and just pay whoever the utility provider is going to be. And because the utilities operate with a regional dominance economic moat, they don't have competitors or rivals, they're regulated. The government and the jurisdiction or the municipality, they put a cap on how much they can charge per kilowatt or for each unit of power that the customer, client, resident, whatever, how much they use. That's a drawback, but I think it balances out the fact that in a specific territory or a neighborhood, it's a monopoly. They don't have a competition. So having said that, I think after this stock deep dive, the next one that I'm personally going to be doing some homework on is going to be Constellation Energy to figure out if the threat from the party in power is going to be legitimate or if it's an opportunity to buy into a utility that's powering up a crap ton of data centers in New Jersey. So I don't know. Now, making a U-turn back to SIMO, let's talk about the cheese situation. What are the things that you need to take into consideration? Number one, the first bullet point, I have the AMD pivot. Let me explain myself. So, formerly, Silicon, they were always known as to be a very cyclical PC company that was very popular with the gamers and enthusiasts because when you were doing a custom PC build, you wanted to make sure that it was a Silicon Motion Technology NAND flash controller. Now they have made that transition and pivot to becoming a part of this AI infrastructure ingredient. So as a result, their SSD solutions business, by the way, I forgot to mention this during the recent earnings, the SSD solutions business grew by 110% year over year this past quarter. It just shows you that the momentum is on their side. And that's why I put the AMD pivot, because it reminds me of how AMD, they made the pivot from being known as the gaming CPU to being the data center giant that they are today. I think they're a distant second place from Nvidia, but they're still a pretty beautiful business operation. And then the second bullet point that I have is distracted. Reason being is that they're gaining a crap ton of ground in the NAND flash controller space because the major NAND players like Samsung and SK Hynix, they're so focused on producing and manufacturing the next generation of the high bandwidth memory, the HBM, that they're kind of jumping ship with the whole NAND flash controller landscape. So as of right now, at the time of making this video, they're leaving the entire door wide open for Silicon to come in and make the NAND flash controllers for smartphones and for PCs. They're about to have a monopoly, essentially. And so when you think about it, the reason why Silicon Motion Technology is thriving right now, not only are they making the SSDs for the AI data centers, but they're also taking up the market share that their competitors are allowing them to take. So it's the perfect scenario for SIMO to thrive, and that's why their stock price is exploding in the past 6 months. Blue skies and rainbows for them, essentially. Just growth catalysts, one after the other. And there's another one that I'm saving for the end of the video, another huge growth catalyst. And if you take a look at this market research from Mordor, I'm assuming he's a Lord of the Rings fan. If you can't tell, on the back over there, next to my Tottenham Hotspur's flag, I have a photo of Rivendell. So I'm also a huge Lord of the Rings fan. Sorry, I have my throat. But based on Mordor's research, they're thinking that the CAGR for the SSD market's going to be 16.03% year over year through 2031. So effectively, the market is going to go from $36.3 billion a year to $76.4 billion a year. And because Silicon Motion Technology makes the NAND flash controllers for the SSDs, they're getting a piece of that pie. So their growth for the next 5 years, according to Mordor, is going to be pretty bright. And the next bullet point that we have to talk about, you can't ignore it, is China. And the reason being is that SIMO, they're headquartered in Taiwan. Yes, they do have an office in San Jose, California, and I think they're incorporated in the Cayman Islands for tax purposes, but whatever. Almost all of their stuff is made by TSM in Taiwan. So when you think about the geopolitical risk, if there's any tension in the region, it's going to be a very messy red day for SIMO, as evidenced by TSM whenever China decides to do a military exercise with their naval fleet in the area. TSM sells off for the day. The good news is the leadership team's being proactive because they've been diversifying their supply chain to having some of their NAND flash controllers made by Korea's Samsung foundry. So they're not 100% concentrated in Taiwan anymore, but still the exact same geographic region. Korea, Taiwan, China, they're all pretty close to one another, but I think if China does invade Taiwan, I don't think they really want beef with Korea, which means if Taiwan goes down like Hong Kong and Tibet, I don't think Korea's operations are going to cease. It's just going to be business as usual. But if China does make that aggressive move, I think the world as we know it will radically change. Now, for my undergrad, I went to a military academy, and so every single year we took in a bunch of cadets from the various military academies around the world, from Germany, from France, and specifically Taiwan. And dude, from my friendships with the Taiwanese cadets, I learned about the Chinese Civil War and how much disdain and how much they hate the Chinese. And the thing is, as an American, we did not learn about any of that in our history classes, right? So they put me on, and now I'm up to speed about what's happening, why there's so much tension. And when you think about it, Taiwan, they're an American ally, whereas China, they're not. But having said that, based on my understanding, Taiwan as a whole, I mean, obviously there's a vocal minority there. I think as a whole, they don't want to be a part of China. They think they're the real China, and they just want to be a sovereign nation, a country that operates independently from China. Whereas China thinks they still belong to them, because ethnically they're from the same group of people, but because of the Chinese Civil War, they had to flee. And if you get down to the root of it, China really wants Taiwan because of their economic prowess. Dude, TSM, MediaTek, Foxconn, and Silicon Motion Technologies, there's a reason why China wants Taiwan. It would literally boost their GDP by a crap ton. But anyways, this is not a video about the China relationship with Taiwan. So now let's go ahead and calculate an inherent worth for the stock price of Silicon Motion Technology based on their own numbers and financials. And by the way, this spreadsheet that you see on your screen right now, it's available on the Patreon. That way, if you want to plug and chug a stock of your choice, you can go ahead and do that, okay? So, predicated upon their revenue growing at a rate of 15% year over year, because based on the market research of 16%, I'm going to shave down 1%, and their net margin stabilizing at 15%, then the cheese value per share, they should realistically be $132.97. Friends and family, at the time of making this video, they're somewhere around like 136, 137. All case and purposes, I would argue they're fairly valued. So I don't even know why I would reveal this block right here at the price that I would hypothetically pay with a margin of safety baked in. That way, if I buy into them, the upside is a lot more probable than the downside. And I'm not buying into them at their top peak price. There's more room for them to go up than to go down. Now, obviously, in the stock market, anything can happen, but that's why you have a margin of safety. $99.73, they're nowhere near that price. Now, having said that, I was going to calculate an intrinsic valuation for SIMO based on the earnings, their EPS, but I think it's going to be really difficult to do that because when we're going to take a look at their numbers here in a little bit. When you take a look at their profits per share, dude, it's so volatile. It's all over the place. I mean, even though they're crushing it right now, for this most recent earnings, they missed the bottom line expectations. So you can't really generate a forecast when a company is so shaky on the profitability per share. And I would argue when it comes to their PE ratio and their EPS and everything else, it's really difficult to forecast more than a year out for a historically cyclical sector because their revenue explodes and then it declines. We have to keep that in mind. That Silicon Motion Technology, for the entirety of their history, has been a boom or a bust type of business operation. It's never a smooth, steady sea where they're consistently and reliably growing. There's highs and there's lows baked in. So if we just play along with a very bullish vision that the data center movement is a structural shift and that we're going to be constantly building out new data centers, then I guess the GARP formula that we just saw, it makes sense. $133, $134 a share for SIMO. But a price generated predicated upon the earnings forecast, I think it's way too challenging. And that's why I'm really glad there's various different calculators to figure out the stock price, right? You don't have to just use one. Believe it or not, SIMO pays a dividend, but the dividend discount model wouldn't make sense because their dividend profile, it's flat. They don't grow their dividend. So based on that, it would spit out a stock price that's way too bearish. So having said that, based on the adjacent companies that are pretty much doing what SIMO is doing, what is a fair price for them predicated upon a median PE ratio of a 28.7? They should be around $104.52. So based on two different models, they're overvalued or fairly valued for the time being. And if you take a look at their valuation right now, their trading multiples are 37.8 based on the trailing 12 months earnings per share, but their forward trading multiple is a 24.3. So by all regards, the company is not cheap at all. And so when we take a look at the compounder chart, all of these companies that you see on your screen right now, you can pause this video, you can look up on the channel, including Hims and Hers Health, Lululemon, Mondelez, Gambling.com. Where would I put SIMO? So prior to doing a deep dive on them, I'll be honest with you, I felt bearish because on paper, it's a cyclical business. It's shown in their inconsistent revenue. It's like looking at a roller coaster, pretty volatile. It explodes in one year and then it decreases by a significant amount the next. And it wasn't until recently that Sandisk and Micron started exploding in valuation as well. So when I think about SIMO, I think it can cycle the other way just as fast. So if you buy into them at $135 a share, you might be caught with your pants down by your ankles and everyone sees your tiny wiener because it's cold outside and you're doing the Wim Hof method. For crying out loud, here in Japan, it's like 21 degrees Fahrenheit. Of course your wiener is going to shrivel up because when the cycle goes from boom to bust, it decelerates really fast. When you think about what's happening objectively, like Micron, Seagate, and Sandisk, they're exploding in valuation because of the SSD shortage. The data centers need it, but there's not enough to go around. And so the profit margins are going through the roof, but also the production for the SSDs, it's being in full throttle mode right now to meet the demands of the hyperscalers. And in the semiconductor world, shortages are always followed by excess supply. So right now they're ramping up production, but it'll come to a point when the data centers are going to be like pushed back and they're going to be like, we actually don't need that much anymore. And they're going to have a crap ton of inventory of SSD products that no one's going to be able to buy because it's made specifically for the data centers. And if the data center customers don't need it, then you're kind of out of luck, right? So I could be wrong, but will we see that type of capex on data centers from the Mag 7 every single year going forward? Amazon spending $250 billion the next year. Is that going to happen? I don't know. Or is their infrastructure almost future-proof and it's good to go after this year? Meaning less data centers are going to be sprouting up left and right. Because, as evidenced by how Wall Street and investors felt about all that capex, they punished Microsoft and Amazon by like 15% on a single trading day. So is that something they're going to continuously do year after year? I don't know. I think the more likely scenario is that the Mag 7, they are going to continue producing and manufacturing data centers, but not at the scale of what they're doing in 2026. So the CapEx number, I would think, would shrink for like Amazon down to like 125 billion or even a smaller number, which means less money going into the pockets of Silicon Motion and anyone else that's involved with the whole data center physical operation. So having said that, I know this might be an unpopular opinion. When it comes to Silicon Motion, I would place them into the C tier because of that cyclical nature of their business model. Now, if they were Nvidia or AMD, where their chips are always going to be necessary for every application in life, EVs, appliances, and data centers, they would be over here I think it would be a mistake for me to only categorize them into the S tier by looking at what's happening in the past 6 to 7 months. When you look at the entirety of their timeline history and their DNA, it's a boom and bust type of stock, as we learned about their total returns at the beginning of the video. They pretty much trade flat because their revenue and their numbers are flat and volatile for the years where they're not booming. Right now is when they're at the climax, when they're at the peak, when they're thriving. Now, obviously, that could all change in the future and they could continuously thrive. And personally, I do not know. However, I don't think it's an insult to put them into the C tier because for me, I have really high standards, and a company that's categorized into the C bucket means they're doing everything they should be. It's average, which means they're going to be getting market level returns, and they're not good or bad. They're just decent. They're in the same company as Hess Midstream, which is probably a top 25 dividend payer. I'm not exaggerating when I say that. They're also in the same company as Ford Motors. So it's not to say that it's a bad placement. Now, I don't know about you. I think it's time that we look at their numbers, their data, and their financials, and I'll add some color to what I am seeing. So I think before we go off with the P&L statement, let me just take a look at Micron. And their one-year ROI is 315% into the green. With silicone, we're seeing a share price appreciation that's almost exactly half that of Micron. But that makes sense because the SSD is more important than the NAND flash controller. But 160% in 365 days is really respectable. And based on what's happening in the past few weeks, their RSI is around an 88 to a 91, which means it's in that overbought territory. One second. But in an optimistic lens, they also have a bullish sentiment and momentum for them. It's pushing them and propelling them to a higher price as more and more people get FOMO and they're jumping in. Having said that, now let's take a look at their P&L. This is what I wanted to really highlight. Right? This is a company that has highs and lows inherently baked in based on the cycle of the semiconductor chip space. You take a look at it, right? 2016, $500 million. You would expect the following year to be what, like $600 million, and then the following year to be $650 million? That's just not the case. It drops, it explodes, it drops, it explodes. That's what I mean by when I refer to silicone as a boom and bust type of business. That's not to say it's a bad thing. You just have to understand the cycles. There's highs and lows. And that's why I was saying earlier, I would personally never want to buy in during their boom phase, because when the tide shifts, you're going to be caught holding the bags at their all-time high valuations, right? So their gross sales, I'm not exactly a fan of what I'm seeing here. There's highs and lows like that, kind of offensive to me. On a quarterly basis, obviously we're seeing growth that is very similar to what they saw in Q1 of 2024, Q2 of 2024, 50%, 50%. Now it's at 45%. But if you take a look at some of the previous quarters leading up to this, they were negative 5%, negative 12%, negative 5%. You know what I'm saying? And as we scroll down to take a look at their profits per share, this is the reason why I could not calculate a price for them based on their EPS of how inconsistent it is. The profits that they make is predicated upon the gross sales that they're generating, and then how much of that is going into their pockets on an accounting basis. But if the overall pie, the piece of the pie that they're getting is shrinking, obviously the profits are going to be shrinking as well, unless they optimize their margins, and that increases year over year. But in semiconductor chip manufacturing, that space, the margins tend to be pretty stabilized. As a matter of fact, TSM could charge you more, and then your margins would decrease. So I'm going to tell you right now, I am not a fan of the highs and lows and the highs and lows of what I'm seeing when it comes to their earnings per share. Because in a perfect world, what you want to see is a trend of their profits per share growing up and to the right. Yes, they could have a fluke year here or there where it might drop a little bit, but over the grand scheme of things, you want to see it be increasing. With silicone, like that's not the case. There's highs and lows depending on the year and the cycle. Case in point, if we take a look at, I don't know, Microsoft, right? Just to paint an example of what you should be seeing in a high quality compounder, take a look at their gross sales, the top line. Every single year without fail, it increases. There's no inherent highs or lows baked in, boom or bust volatility, such as the cyclical semiconductor chip space. If you take a look at their EPS, up and to the right. Obviously, 2018, something happened. Maybe they made a merger and acquisition. Maybe they had an accounting write-off or a tax situation. But over the grand scheme of things, if you look at it, bird's eye view, it goes in the right trend. 2016 was $2.56 of profits per share. Trailing 12 months, it's just shy of $16. That's what I want to see, that predictability, the reliability, the consistency. With Silicon Motion, there is no reliability. You don't know what you're going to get next quarter. So circling back to Silicon, because the EPS is so unreliable, how does that manifest with the dividend profile? Take a look at this. Their dividend yield right now is 1.4%. It's sustainable at a 54% payout ratio. What does that mean? It means out of their profits per share, what we just saw, 54% of that is going to be utilized to fund the dividends on an accounting basis. But the real ones know that the dividends are actually funded through the cash that's coming into the company. So the free cash flow per share is a better proxy, in my opinion. Obviously not the case when it comes to rates and utilities because they're a capex heavy industry. But if we scroll on down and take a look at the dividend, look at this. Right? The dividend cannot grow because the business model itself is not predictable. And so they can't forecast growth in the dividend just to cut it the next year. They don't want to do that. So they would rather just keep it flat because they don't even know if their profits per share is going to be steady, if it's going to be smooth, or if it's going to drop off a cliff. Does that make sense? That's why after the pandemic, they pumped the brakes. And I think they even halted the dividend altogether in a majority of 2023. Not exactly what you want to see. The dividend profile speaks volumes to the quality of a business operation. If you are able to consistently grow that dividend, then it shows you that your profits and your operations are smooth sailing to the point where you can, with confidence, tell the investors, dude, I can grow my dividend by 7% and it's going to be sustainable because our profits per share is growing by, 20%, 30%. When it comes to Silicon, it grows, it falls, it grows, it falls. And that's why they don't have the confidence to grow the dividend. Hopefully that makes sense. And that's why I'm not too in love with what I'm seeing so far. If we jump on over to their balance sheet, now obviously this is a pretty small company, $4.6 billion. So keep that in mind as to why their cash and cash equivalents is such a small number. $200 million. Seems to be pretty stable across the board. It seems like that's what they want to be near. Around $200 million seems to be the case throughout their timeline. But actually, I would argue $300 million would be a more closer, accurate figure. So $200 million, it's kind of dropping off. And if we take a look at their total debt, I guess as of right now, there's no debt on the books. So friends and family, I would say that's a green flag. And just to confirm whether or not they do have debt, let me just change the data input. Yeah, they don't have debt right now. Total debt is 0. So I would argue that's a really good thing. It kind of reminds me of Cal-Maine. I think they also have 0 debt on the books. Could be wrong, but yeah, Cal-Maine, the chicken egg producer, they don't have debt as well. So bouncing back over here, I would say their books look clean. And if we jump on over to the cash flow statement, let me see. Scroll on down right here. Free cash flow per share. You see what I'm saying? Highs and lows, highs and lows. To be honest with you, this is really hideous. And the fact that in 2021, it was $4.21 of free cash flow per share, and now it's 19 cents, I'm almost triggered. I almost need my safe space to just vent and scream. Like, that's really ugly. And to jump on over to the ratios tab, the next thing that I'm trying to assess is their ROIC in relation to their weighted average cost of capital. And when we do that, one thing that I'm looking at is a trend that's consistent or growing. And one thing that I'm seeing is a trend going in the opposite direction because their ROIC, the return on invested capital, it essentially tells you how efficiently they're using their capital, meaning their loans and the shares that they dilute the shareholders with, if they're using that to generate profit or not. And in 2016 and 2021, I would argue really good. However, since 2021, it's been dropping off a cliff and now it's 12.8%. Not exactly the trend that you want to see. And if we put it up against their weighted average cost of capital, which tells us the cost of doing business, it's an 8.1%. So at least the ROIC is a lot higher than their weighted average cost of capital. It means that SIMO is making more money on its investments than it costs them to run the business. So every dollar that they put to work is growing shareholder value, not destroying it. So the ROIC situation, it looks kind of ugly, but if you look at what matters the most, it's still above the weighted average cost capital, so not too terrible. And then circling back to the boom and bust nature of their revenue, it's portrayed by their stock price movement as well, right? Sometimes it goes up, sometimes it falls off a cliff, sometimes it goes up, falls off a cliff, and right now they're in the progress of reaching new all-time highs. I don't know when the peak is going to be. For all we know, it could be 150. For all we know, they could have reached it today, and now it's going to start falling. We do not know. But do you remember how I said there's one more growth catalyst that's headed their way? Before I show it to you or talk about it, their free cash flow, they're generating about $6 million of free cash flow, which is kind of small, right? However, they're about to get a $160 million legal settlement for a failed acquisition with Max Linear. In 2023, they were trying to become one company. It fell through. So they're going to have to pay Silicon $160 million for their troubles, their heartache, and because it didn't work out. It's similar to how Adobe had to pay Figma because their acquisition failed. I remember when that happened, the stock market was so pissed off, and I think the fees, it was around $1 billion. I could be wrong. I think it was around $1 billion. And so $160 million pouring in straight up cash, their free cash flow should artificially be pumped sometime in the near future, maybe in the next 5 months, 8 months, whenever that goes through. But anyways, my overall opinion on Silicon Motion, I think cyclical stocks, they're a perfect reason as to why they can be a good long-term bet, especially if you buy into them when they're out of cycle and near, I don't know, if we take a look at this, if you buy them around their low valuations. But then again, to add some context, if you bought into them in September of 2016 at $51 a share, and you fast forward to 2025 January, they were still like $52 a share, you probably wouldn't be a happy camper. But if you just hold on and do nothing, obviously you would have experienced them exploding in valuation. But with cyclical stocks, you just don't know when that boom is going to happen. But for some optimists, they're going to say it's only a matter of time before the boom occurs. So Silicon Motion, it's not a stock that I would buy and hold. As outlined in the investing philosophy slide deck that's up on the Patreon, I feel like if I were to jump in, it's FOMO. I'm just trying to chase the hype and the momentum that SIMO has right now. I wouldn't necessarily be investing based on their fundamentals and financials. I'm not a fan of what I just saw. I mean, their trend across the board for any metric, it's so inconsistent. If I were invested into them, it's definitely a company that I would capitalize to sell as they reach their high end of the boom phase before they transition into the bust cycle. Now, having said that, I do want to reiterate that bust cycle may never come. If in fact, the SSD demand will always be strong and it's a new norm. But historically, if you take a look at semiconductor chips and all the players in it, there's highs and lows. Ultimately, it's a business that I will not bother putting on my watch list. I just don't think it's high quality. Obviously, what they're doing is very important for the data center landscape, but it's not a company at $135, $140 a share I would feel comfortable adding to my portfolio because I feel like the statistical odds of the downside is a lot higher than them reaching $220 a share or $250 a share. For them to drop back down to $50 a share, I wouldn't be able to sleep at night. That boom and bust nature is just really makes me uncomfortable. My last remarks, please do keep in mind that I'm an idiot. All of this is wrong and inaccurate, what you just watched in this video. So please do your own research and due diligence so that you can formulate an opinion on the company. Just because I made a dedicated deep dive on Silicon Motion technology, it does not mean that I endorse or recommend the stock. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you really soon. Go Seahawks, by the way. We won the whole darn thing. Dude, I'm so freaking happy. So happy. And I'm not going to lie to you, our defense put in the work. Dude, we sacked Drake May like 10 times or something like that. But I still think Sam Darnold's story is pretty inspiring because he's been a journeyman ever since he entered the NFL. He bounced from team to team. And he finally won a Super Bowl. He's always been a quote-unquote mediocre quarterback, except his last season with the Vikings. He crushed. I don't know why they let him walk. Honestly, Sam Darnold is a better quarterback than J.J. McCarthy, but that's an unpopular opinion because Sam Darnold was good enough to win us a Super Bowl, right? So, pretty happy guy.